Hello, everyone, and welcome back. We have today a very special guest, Martin. And by the way, very special because today is starting off the Stampede in Calgary, Canada, which is a massive event, right, Martin?
Absolutely. I got my cowboy boots and my cowboy hat all ready to go, all cleaned up and ready to ride a bull on a horse.
I'm so jealous. I'm so jealous. I
Sounds
really need
wonderful.
to put it in my calendar for next year.
Absolutely.
Look, just to give a bit of more about Martin. Martin is senior portfolio manager at Wellington Altus Private Council. Martin has over 20 years of investment industry, including senior level positions, both on equity research as portfolio management. Again, Martin is very well known in the Canadian structured products market. So you're the second advisor from Canada or from the wealth space. And there is a reason for that, right? It's the market is been growing a lot, especially on structured products. But we have Martin for a very special reason. He loves more than me a very interesting theory how to manage clients' portfolios, even our own, which is gold-based theory. So today's podcast is going to be focused about that. Now, Martin, of course, we can talk all about all theory, but in reality, it's a reality that counts. And I would imagine that, let's say, the beginning of the year until today has been a roller coaster, right? From the beginning, first 4 months of the year, especially in Canada, right, with the US. How has that been for the advisors?
Yeah, it's been a really challenging market, especially when it comes to managing client expectations. Where traditional portfolios like the 60/40 are no longer behaving as expected. We've got a lot of macro uncertainty out there, a lot of geopolitical instability, and a market that went from the world is ending to now defying economic fundamentals. And so advisors are going to have to try and manage expectations. And if they're being asked to deliver growth and protection at the same time, that's a really tough balancing act. So advisors have got a tough role to play in today's really uncertain market.
So let's go for, I think, something which is very, very typical for typical advisors, at least when they start, which is the 60/40, right? That's the traditional way. We have other people, suggesting that 60/40 is enough, getting all your portfolio into equity is enough. So how do you see portfolio theory working?
Well, it has worked for so long, and so because it has worked for so long, it's become the standard of conservative investing, and it's even implemented within many investment policy statements, with bonds being the counteract to equities. But they have more recently failed to hedge equity risk, and rising interest rates have eroded fixed income returns, and so they've failed to deliver in today's environment. We think the model still has some merit, but it needs to be reimagined per se with some more dynamic tools like structured notes, alternative investments, dividends, and that sort of thing. The issue about this in today's environment, we're in a very unique structural environment where governments are issuing records amount of debt and running large deficits. And as a result, that's being paired with tariff risk is putting pressure on bonds and bond yields. And so we could continue to have market corrections like we saw earlier this year where bonds are not providing any downside protection. And so you're going to need to think outside the box if you have clients that want to have stability in their portfolios. That means looking outside of the bond market.
Do you feel as though the kind of the volatility you're talking about, the geopolitical volatility you're talking about, is that affecting the stability that clients are looking for and their expectations for stability almost?
Absolutely. Volatility amplifies emotion, and clients become a lot more reactive and more anxious and susceptible of losses and fear of missing out. And they want to participate in the rallies, but also demand protection from the drawdowns, which is impossible to do as an investment manager. You just can't predict near-term moves. Very few predicted the sell-off that we saw, and very few predicted the recovery back. And so there's inherently some conflicting goals with managing the tension between, the real value of where advice lies. And I think where an advisor can really play a good role is protecting clients against themselves, and that means trying to remove the emotion from the correlation of emotion with volatility. And the best way to do that is by trying to lessen the volatility of the portfolios.
Yeah, wonderful. I think it kind of moves well into our next topic of goal-based investing and how that is working with volatility. Just from my understanding and understanding of others as well, how are you defining goal-based investing kind of in your own word, in your practice?
So about 7 years ago, we spent a lot of time revisiting our practice. And instead of trying to reinvent something new and exciting, we spent a lot of time in the US, in particularly Los Angeles and New York, understanding the US RIA model. And the US tends to be a lot more advanced in regards to a number of things in the financial planning world. And they were shifting towards what was called goals-based investing. So that means aligning portfolios with a client's specific life objective, whether that's retirement income, capital preservation, or legacy planning. And it shifts the focus from beating a particular benchmark and achieving, instead of trying to outperform that benchmark and trying to achieve outcomes that really matter to the clients personally. So in many cases, I'm retired, I generate a lot of my wealth by taking a lot of risk in my business or my practice. I don't want to take that risk anymore. I don't want to have that volatility. I don't have that control over managing that risk anymore. I'm going to hand that off to you. So I want to get a decent rate of return and minimize the volatility around it. So that means giving away some of the upside capture in order to have some of the downside protection, and then removing the value of removing that anxiety from the equation and start enjoying your life.
Yeah, Martin, for me that look, I also love the goal-based theory, right? Because it's not something that, everyone that just talks, yeah, you should get, actually, this is something which the last few weeks getting me on my nerves. I see all these people talking about how you should invest in equities, you'll get 8%, and that 8% is always there. It's exponential growth, and in reality, why? I don't care about that. My parents don't care about it. They're in an age that they have their own goals. They want to retire. I don't care about 8%. I want to know that I will have enough savings to pay my kids' university, wherever they want to go. US, Brazil, whatever, if they want to have a good fun. As well as my own targets, term of retirement, or even build a second house and yeah, I think that's quite relevant, right? Because it's a bit very different from how the financial industry works, which is so focused on these 8% and keeps trying to sell it as something that it's always be there and that should be your target.
Yeah, and there's no doubt about it. If you're investing longer term and you're a younger person, investing in equities and holding said equities for a long period of time is a prudent strategy. However, you sell your business for $5-6 million or 10 million or a million, whatever it is, and that's what your retirement savings are. Sell your house and you're renting and you're downsizing and you're living off that capital. You can't afford to have a 20% drawdown on that portfolio. Well, you can, but you're going to be pissed off and you're going to have a lot of anxiety about that because I'm going to tell you, well, just hold it. Markets will come back, which they ultimately do. But the value of not having that drawdown is tremendous, tremendous. And so you start to anchor away from the market headlines because the market headlines are all over the place,
Yeah.
and instead anchor to what particular goal you want to achieve. In the old days, you used to be able to retire, do a ladder GIC strategy, right? And then you go and enjoy your life, and you don't have to worry about anything. And so that there's tremendous value in that. Now you can't do that in today's environment, even though interest rates are higher, because if you
Yeah.
go longer term GICs, you're getting a rate that's on par with inflation, so you're not being able to live off that capital. All you're doing is protecting it against that inflation. And so the value of goals based investing has always been there, but it's now being reinforced because of that volatility that we're seeing in the markets.
So let's talk about, right, because how effective is goal-based investing versus the 60-40 into the different market scenarios? I mean, when there is uncertainty like it was at the beginning of this year, and how effective it is when markets are rallying.
So that's where some coaching is involved, and clients have to understand how the portfolios are going to perform in both up and down markets. In turbulent markets, you're going to have less downside, and so you can stay grounded more so. And when markets rally, you're not going to participate fully with the rally, but you will participate. So, for example, with our portfolios in 2022, we were down 2 to 4 or 5%. Well, 60-40s were down 15% to 16%. And that was tremendous value in that because clients looked at their portfolios and said, oh, wow, this is so nice not having that. Now, the year after, when markets rallied back, we tracked back 75% of the rally, so we didn't get the full capture. But when you do the return profile over the last 5 years, for example, we're going to be ahead of a passive portfolio, but we got there with a lot less risk. And so what I'm saying is the pattern of returns are very, very important when you're investing, especially when you start drawing out capital from that portfolio and you start drawing on it. And if your pattern of returns are front end loaded in regards to losses, which they can very well happen, just bad luck on timing,
Yeah.
the terminal value of your portfolio is going to be dramatically different than if the losses were back end loaded. So we just don't know whether the markets are going to continue to rocket like they have the last couple of months. And if you're if you're retiring now or selling your business, we don't know if it's going to be front end loaded or back end loaded. We just even want to go there. So we want to make sure that we can smooth out the return profile and get that said target return. And we find that most clients in a conservative nature with a larger portfolio, if they're getting 6 to 8% annualized net of fees and you're smoothing out the returns, they're very happy and there's a lot of money left over, whether it's for their kids or for charity.
So let's talk about because you already mentioned about the emotion from clients. How do you manage those expectations, right? Because it's slightly different from a simple long portfolio where you say, well, market is market, you just keep investing.
Yeah, and so it's very important to, when we bring on a client, we do a mutual interview to make sure that there's a fit between what we're doing and what the client's expectations are. If a client wants us to pick the next best thing, whether it's Bitcoin, gold, or energy, or some tech stock, that's just not us. That's not what we do. And we're not going to add any value there. I'd probably go as much to argue that very few advisors over the longer term can add a lot of value there as well. Picking which one's going to outperform is a pretty tough thing to do, and there's all kinds of evidence showing that over the longer term in the S&P 500, because of the efficiencies of the markets, that you're not going to be able to do it. And so we start there. That's the main point. And then we say, okay, how are we going to do it? What are the tools in our toolbox? Some are engineer-like and they want to get into the details and they want to understand that, and that's fine. We have full transparency and we can geek out, and we actually like that. Others, we establish that rapport and trust, and they're trusting that we're going to implement the strategies that are going to achieve those goals. And we have an education and transparency process. So we explain both the positive and the negatives of the types of tools that we're using. There's no such thing as a free lunch. We all know that in this business. And we explain the risks and the upsides, and then what the expectations are for the portfolio and how it's going to move in regards to the tools that we're using.
Yeah, I think it's really interesting the way that you're kind of almost hedging the fear of the investor. A really interesting strategy to do that. Do you have any kind of examples of how you've had to talk people down from the ledge almost in goal-based investing and just maintain the course? Because it can be difficult even from the beginning to the end to keep that emotional kind of stability the whole way through.
Yeah, so it's effective communication. I think in the end, the value, how the portfolio performs really it works for itself. So like I mentioned back in 2022 when markets were down significantly, we weren't. And so when clients look at their portfolios and there's a big correction in the month, and they'll see that there isn't going to be a big one in their portfolio, and they can see that the tools we're using are delivering everything that we said that they're going to deliver on.
So let's talk about structured products, right? Because Personally, I feel that structured products fit extremely well with goal-based investing, right? Especially when you have the specific goals in terms of terms, right? Because it's also important, right? The idea behind it is that you can have your buckets, your goals. You can have one, two, three, four, as many as you want, and each goal will have a specific time where you will want to achieve it, right? One which is in 2 years, another one which is 5 years, and depending that you build those different portfolios to get to those goals. So for me, actually, structured products fit quite well, right? Because they have the term, they have the growth, they have the participation, or they have the income to achieve that goal. How do you use structured products to fit your theory?
Okay, so first of all, we look at them as a fixed income replacement, especially in non-registered cash accounts. You're going to have to pay tax. They're taxable as income in Canada, and in bonds they would still be taxable as income, but you're just not making any money in bonds. You're not paying tax.
Yeah.
Whereas in structured products, you can design a fixed income like replication. And the way we would look at that is something with big, large drawdown, downside barriers, buffers, principal protected notes as a sort of a corporate fixed income replacement, maybe even some longer term GIC type of notes that could be a government replacement. And the risk is the counterparty, but we're not too worried about that with the Canadian banks. In RSPs and registered accounts, we can actually do an equity replacement with those notes. Now, having said all of that, the goals depend on income generation, capital protection, or volatility smoothing. Those are the three main areas that we look at notes. And with equities themselves, if you're just looking for pure growth, you're much better. I'm not going to argue with some of the people have put forward in regards to notes versus equities. Yeah, go ahead. And if you want growth, you're much better to own equities longer term. I don't disagree with that at all. But if it's a goals-based portfolio and you need some security around that income generation and you want some capital protection, and most importantly, smoothing out the return profile with the pattern of returns, then structured notes make a lot of sense.
Exactly, right? Because the whole idea, right, of goal is to get to your target, your goal, the quickest and with less risk as possible, especially with the risk of drawdowns, right? That's the main concern. So if you think about how do you talk about structured products with your clients without not going too much technical and talk about volatility, dividends, and other things?
We really try and simplify the message. We use a lot of visuals, analogies, real world examples, and we explain the profiles. And the closer we can get to the clients understanding the why, they're going to be more comfortable with the how. And so we look at education, we explain the profiles. In many cases, the response is they sound too good to be true.
Yeah.
And how is this even possible with the explaining the outcomes? And so we walk them through how a note is built if they want to get into that kind of detail. We explain the option market, we explain volatility, how people pay more during periods of volatility for insurance and people pay less during periods of complacency, how that impacts the pricing of these things. And again, it's just getting your feet wet and seeing how they work and understanding the pricing. I think it's very important also to understand that when you're early on discussions that the underlying value of the notes, they are marked to market on a daily basis. They will price, if it's a principal protected note, for example, you'll still see it trade below the par price. You set the groundwork for them for understanding why that's the case and how it's going to perform and impact the portfolios.
Yeah, I think it's really interesting. What role do you think that structured products play in just supporting specific goals for each individual portfolio individual?
They're really versatile and they can provide a lot of different types of satisfaction for goals and achieving of certain goals. So you can get equity linked income with downside barriers. You can get somebody who wants some principal protection without risking any of their capital. We have some clients that, for example, including my parents, have sold their real estate. Fortunately, they got lucky. They sold their condos because the condo market's not doing very well in Canada right now. And the rental market is really cheap. And so they've taken all their capital out of all their real estate, and now they're living off of that equity that more than covers their rent and gives them travel money and everything else that they want to do, and they're able to free up that equity. And they're not seeing, I mean, we're doing lower risk monthly contingent notes for them, so they're not getting a lot of, with geared buffers and some more customization around the downside, so they're not getting the excess volatility, but they're getting sort of a GIC replacement income higher than GICs today, but 5-6% after fees and everything, and they're really happy about that. And we have a lot of clients that are doing that similar type of strategy, $2-3 million of real estate that's off the market, and now they're living off that equity, and they're living quite comfortably.
It sounds like you're a big advocate for structured products. Do you feel like other advisors are kind of underusing them or misusing them in their portfolios?
Yeah, both. I think they're not using them because of the perceived complexity of them. Others are not really fully aware of understanding all of the risks. And there's some lack of education, I think. And also the banks, there's some proprietary product, for example, that they would prefer that their advisors use when it comes to mutual funds and things like that. Advisors can make some mistakes with the notes that they purchase. For example, I've seen some not so good stories around single stock structured notes, and them being down, 75-80%, and then not understanding why that's the case and having to explain that with clients. So maybe they get off on a bad footing with picking the wrong note structure for their clients. And so I think there needs to be some more education around that and getting them comfortable with understanding how they work and how they're built.
It does seem to be a common kind of theme that a lack of education is kind of holding back the market at the moment. I think it's something that obviously we're trying to push forward with. Hopefully, 5-10 years time, it's a little bit easier.
I think there will be a buy-in like there is south of the border. I mean, we're still in the advisor community a transactional base. There's still a lot of transactional based advisors, which is fine because some of them really like the notes because you do the class A's and you get a nice juicy commission. But we're going to, as we transition to discretionary portfolio management, and we're going to transition towards goals-based investing like the RIA model and heavy financial planning that's going to be integrated into that, they're going to want to move away from beating benchmarks. Especially if some of them start setting up their own pool funds, of which we have our own fund, you're benchmarked. And so you're going to want to move away from, because you're not going to be able to, it's going to be very, very difficult to outperform a benchmark if you're just doing pure long, and you're picking stocks, for example, or you're underweight the US, and let's say you went overweight the US and the currency's down 11% this year. Yeah. It's really tough. And so, yeah, you're going to be disappointed because you're not going to be able to deliver on the top performing market.
Which is, I think, we should talk about, right, where we are now. I mean, we have a Chinese economy which is currently weak, right? There's this not with the growth. You have war in Middle East. You have the tariff at the beginning of the year. It's still there. Right? There's still a lot of instability. So you had a massive drawdown until mid-April, and now we are beginning of July. Here we are again. We're at all-time highs of the S&P 500, but we clear a much higher volatility environment, even though volatility doesn't show because there is liquidity. So there is the implied volatility is being depressed because of all the liquidity that exists. So, Martin, how do you see advisors now picking up from these moments? What's your advice, or without telling us all your secrets, what's your strategy towards from now forward?
Well, it's important to look at structured products and structured notes as a tool in your toolbox. Now, there's a lot of different tools within structured notes themselves. That's also important to understand. So you can shift the types of notes that you're doing based on the current market, on the market environment, as notes get called away, for example, or as you're getting new money coming into the market. So as you just alluded to, we've come back, and the strategies and the notes that we're deploying for our clients within registered portfolios, equity-like replications, or bond replacements outside of the RSPs, the notes that we're doing are different than they were 3 months ago or 2 months ago. Yeah. And because the market conditions have changed. The market conditions have rocketed back, and yet the fundamentals economically have not improved significantly. And so there's more risk that's not being factored into the market. Whereas, a couple months ago, where the valuations were, there was a lot more risk being factored in. And so let me take a step back. So a couple months ago, we were doing more of the boosters and auto calls for clients. So what that means is that we would track the market to the upside, maybe at a leveraged upside. We would be willing to take a little bit less downside barrier protection because the markets are already down, 15, 20%. And so we could buy something and get levered upside on the eventual recovery because the markets ultimately do recover, although we never expected it to happen this fast. And so you can do those types of strategies instead of just doing monthly contingents where you get paid every month, because if you did those 3 months ago, you're going to be likely called away. And whereas in today's environment where the markets have rocketed back, we're doing more of the monthlies, for example, more of the principal protected notes, more larger downside, geared buffer downsides. We also did a unique structure working with one of the banks where we have a look back feature. So over the next 6 months, in November, it looks back, November, December, it looks back over the previous 6 months and buys the index at the lowest level. And then you get downside protection from that lowest level and you get levered upside from that lowest level. So if markets do correct, you're automatically going to be buying in at the lowest level. So you can do different types of notes in different market environments, and that's where it's worth the time, and that's what you're getting paid to do as an advisor, an investment manager, a portfolio manager. You're getting paid to do that work for the client and integrate those types of strategies based on the current market conditions.
Yeah, I think it's quite obvious you're very passionate about.
What's the one thing that advisors should look at if they want to start using structured products?
I think you want to start small. I'm always about thinking big and building small. That's my strategy and it works really well. So start small, do some research, introduce some of the safer types of solutions incrementally into your clients' portfolios. Ones that aren't going to exhibit excessive volatility, and ask questions and do your research and build confidence through your own education and transparency, and then tying back that to the client's individual goals. I think that's a key step. And then as you get more and more educated, then you can start getting a little bit more exotic, like I mentioned about the look backs and some of the other aspects. But understand how dividends impact the notes and the indices that they're being done. Understand how why a particular note looks like to be a similar index between different providers, but they have a different yield. Ask questions. Why is that the case? And so there's no such thing as a dumb question. If you're an advisor, just go out there and act as a fiduciary on behalf of your client to understand them as much as possible. And then start with something that's pretty safe, and then compare that to a fixed income component, for example, and see how well that's doing, and then start slowly transitioning your clients. And we find that as that happens, you'll start using more and more of the notes.
So, Martin, before we go, because we try to pack all this information in half an hour, we have a few questions for you. The idea is to do quick questions. We're going to ask, and I will ask you to start first.
Yeah,
and
sure.
then you give us an answer. It needs to be short, okay? Just so we can get you like everything for what is in your head. So, Andrew.
Sure, yeah. So can you give me one structured product that you love right now?
I like look backs. I like the ones that if the markets do correct over the next 6 months, I'm automatically going to buy it at that lowest level. And my downside protection is from that low level, and I get levered upside. With the fall in the US dollar, we're actually pricing those out in US dollars and getting 1.6 times levered upside from the lowest point over the next 6 months on Canadian market. I think that's a great trade, and we've been doing that for our fund and our clients.
Okay, so favorite investing book?
Howard Marks. His memos are a masterclass in risk management and market psychology. Howard Marks has made a lot of his wealth for clients in the debt market, but understanding intrinsic value, understanding the starting point that you're investing in, the sum of the cash flows and the value and judgment day, and having predictability of those cash flows and safety margin on the terminal value. Howard Marks has definitely got to be on your list.
Financial markets in one word.
Chaotic.
Are you a coffee or a whiskey drinker after a long day?
A triple coffee, espresso in the morning, and whiskey at the VIX is over 30.
Okay, perfect. And then what one piece of advice would you give your younger self as an advisor?
Patience. Be the old bull. Play the long game. Don't try and predict the market. Focus on building resiliency and focus on client relationships. What you invest today will pay dividends in excess tomorrow if you're willing to wait. So patience, patience, patience.
Wonderful. Thank you.
Thank you. Yeah, thank you, Martin. I think this was very, very good conversation. I really love this topic. Goal-based investing. I think it's amazing, and it's actually how structured products fit
Yeah.
very, very well in a portfolio. Really believe it. So, look, thank you, Martin, for share your knowledge and experience with me and you. Really appreciate it.
No, that's awesome. And the more that we can get advisors utilizing tools that are really going to help their clients and help them minimize the volatility in their own books, the better.
Great. Thank you. Take care.
Awesome. Thanks,
Thank you
guys.
so much. Cheers.